I know you might think trading is boring. Well, I don't want to let you down, but it is. You already want to see some real stuff. Charts, important news, how to trade and so on. But hold your horses. We need to progress with small steps at a time. There must be a reason why the 90-90-90 rule is so hard to break. The market is unpredictable and there is no way to be sure about our trades. However, we need the knowledge to proceed and use the best tools available. Every time we are analyzing the market, we need three types of analysis: fundamental, sentiment, and technical. Most new traders believe that by making some charts and lines, we'll be able to beat the market, some indicators and some other fancy tricks. We need to understand the significance of each tool and how to use it properly. The debate is endless. Fanatic, technical traders will claim that everything is in the chart. For example, when the prices start slowing down, the market is losing momentum, so most likely we are expecting a reversal, or maybe the market is just taking a nap, ready to shoot higher. Indicators show the same with divergence, but still it's too early to speak about that. We try to achieve the best of our speculations by adding all three of our analyses in our trades. Making decisions by using only one is not the best practice. In the description you will find extended videos regarding all these three types of analysis. Exactly like when you are building your own car. A strong engine is not enough. We need to pay attention to aerodynamics. Also, a strong chassis, as a crash is more than unavoidable. We don't want the entire car to be destroyed. The series is dedicated and created to learn how to use all these tools available. In most series you will see that they start with technical analysis. No doubt the technical analysis part is a powerful tool, and technical fanatics will claim that everything is in the chart. However, we will start with the fundamentals. I don't know exactly when you are watching our series, but in the energy crisis in 2022 and 2023, we went short on Euro and GBP. Goes without saying that the long-term performance of an economy is the most important factor. This gives you insight into the market direction. Fundamental analysis, in simple words, is how each economy will perform. In stocks, the analysis is about the same, and we will do a separate video to cover that. For the Forex market, the fundamental is the long-term performance. This includes indexes like unemployment and several others. I have a link in the description for a video on fundamental analysis, and each index is being explained in details. In the Forex market, we analyze economic, social and political forces that may affect currency prices. Supply and demand determine the price. In our case, the exchange rate. We use supply and demand, however, analyzing the factors that affect supply and demand is far more complicated. Policy, economic, production indexes and several other indexes can be combined together to help you with your trading analysis. We have analyzed several times about the USD and the significance of this currency. I will give an example. When the US economy starts to strengthen, with low unemployment, increased production indexes and healthy consumer indexes, the USD will become more desirable. However, this is an oversimplification, as there are several other political and social factors. As the economy gets better, raising interest rates may be needed to control growth and inflation. Higher interest rates make USD even more attractive. However, keep in mind, in economics, usually increased rates are a sign of a weak economy, high inflation, and so on. This is the reason we need to pay attention when we are analyzing currencies at this level. The currencies are always in pairs. This might create distortions in the market. A good performance of a weak currency might not underperform a major currency's bad performance. We will see the Fed chairman and several other economic leaders that drastically affect the currencies. This requires a good understanding of macroeconomics and geopolitics. No matter how complex a market is, we need to start with simple steps. Always keep in mind when you are trading, we are not trading prices but opinions. Here is the main part of sentiment analysis. Again, for this part I have a video in the description to help you with more details. Sentiment analysis, in other words, is how other traders feel and what they believe about the market. It sounds very simple, however it can be hindsight. Most reputable brokers mention short versus long position of retail traders to help them with their trading decisions. We are also analyzing the CFTC report, which is one of the most powerful tools that you can use, and you will also find the relevant video in the description. Commonly, we don't want to trade against the sentiment analysis. However, as a trader, it's an element you need to take into consideration. The market is a complex social network, and the news travel at enormous speeds. The problem is that we, as traders, cannot move the market in our favor. You might see a sentiment with 95% of the traders going short at a pair, and at the same time the price is climbing for days or weeks, outperforming most of the traders. The market will move despite your opinion. Again, in this series, you have already seen us going against the 95% in the sentiment analysis. As a trader, you need to be able to execute your trade after taking into consideration all available factors. If you choose to simply ignore market sentiment, that's your choice. And you have also seen me doing in this series. Most of the time as traders, we need to respect sentiment analysis. Here comes a big confusing part. Based on numbers, most traders suck. 90% are losing money. In this case, we need to consider taking the opposite direction of the sentiment. I know this thought is a nightmare, but this is reality in trading. A zero-sum game. We need losers to book our profits. The next time you see a 95% are short on JPY, stay cautious. The sentiment analysis can be hindsight. The best definition I could say is that technical analysis is a methodical technique consisting of tools such as geometrical patterns interpretations, price action market behavior, mathematical indicators, and historical data. Again, you can find a more detailed video in the description about technical analysis. The market repeats itself. In theory, by looking at historical data, you might be able to determine future market behavior. Most traders use technical analysis as this is a fast way to scan several markets. I choose this type of analysis for the end. The reason is very simple. Things become obvious after the market makes the move. In reality, by using only technical analysis, your method will be incomplete. I am attaching an amazing video about common sense and how this can be applied in your trading. Everything is obvious after the market makes the move. Everything is in the chart, and this is what most technical traders will say. This is partially correct. We will analyze all indicators in this series as part of the technical analysis, so don't worry about that. You will also find experimental indicators that will give you trading ideas and help you improve your results. When we are saying that everything is in the chart, we mean that all fundamental information is there. In time and practice, you will see that this is a very helpful and fast way to scan the markets. Price reflects all the information that is out there. We all know the expression that history tends to repeat itself. The same is for the market, however, not in the same way. Technical analysts look for similar patterns that have formed in the past and try to predict the future price. Again, everything becomes obvious after the market makes the move. A set of statistical probabilities that we can speculate on. Previous market price don't guarantee future price action. This is the first lesson you learn in trading. Technical analysts use charts because they are the easiest way to visualize historical data. Price action analysis will help you spot trends and patterns. All patterns are explained in this series, so you will have time to study them. The idea of using an indicator is not that it can predict the market. Most of them worked as a self-fulfilled prophecy. As an example, if all traders use the standard MACD indicator, then the indicator will start working. Of course, this is in theory. Many people claim can beat the market by using some cross-trading indicators or some fancy tools that eventually won't work. A simple moving average in a trend might be worth millions. Most new traders get confused, and this is normal. Technical analysis is very subjective. The holy grail of trading. What is the best? Unfortunately, there are no answers to this. Or there are several. Trading can become confusing in hindsight. Analyzing the market in the long term or a company that operates well with increased sales and increased investments in assets might be a good idea. However, this is not how the market works. No one can predict the next market trend. I know technical analysts and chartists will say that eventually everything is in the chart. In trading, we are searching for short-term opportunities. We have analyzed several times that trading is risky as hell. Most traders lose in the long term. A very obvious pattern in the market might not be verified. When you are executing a trade, you need to add a bit of everything. No matter how experienced you are in trading, the numbers are against you. You need to use all these type of analysis. Some meaningful lines and some hindsight patterns won't work. You need to be methodical in your trading. In this series, you will find all the tools to create your own strategy. All types of analysis will be powerful tools if you learn how to use them correctly. Remember that every problem's solution becomes obvious after you find the solution. Every market move becomes obvious after the market makes the move. Go back, repeat the chapters you are not sure, and trade safe.